Good morning and happy Friday. It's 9 a.m. here in Hong Kong, in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne.
Our top stories this morning. Apple shares slide after reporting a deepening slump in China sales. Revenue falling 13% for its weakest holiday quarter result in almost 4 years. Meta soaring, though, on a strong forecast, a share buyback, and its first dividend. Amazon's outlook also pleasing investors. Plus, we hear exclusively from Nvidia CEO Jensen Huang about the AI frenzy and the struggle for tech supremacy between China and the U.S. Yeah, I think there's a bit of a theme here today. It's about big tech, Dave. I gotta wonder how long this is gonna last, right? The effect on Asia before we get to that jobs report in the U.S.
Yeah, well, we have a few hours to bask in the sunlight of most of the, I guess, positive strands of the tech story. Moving, of course, there's a completely separate offset, of course, that we're offset as far as Apple is concerned. But, I mean, when you look at this net, right, you look at things like U.S. futures, for example, there's the jobs report, there's strong indications of growth. The Atlanta Fed now, of course, signaling about a 4% growth so far in the first quarter. It's very early, but that does show you, of course, that we are certainly on track for a really mild soft landing. Add mild to the start of that conversation. We are poised for a higher open across mainland China. As things stand, though, we're still poised for a weekly drop. S&P futures, as you can see, if you net things out, you have this massive move up in after hours in Meta, relatively steep drop in Apple shares. We're still higher on U.S. futures. We're coming off quite a interesting Bank of England rate decision. We're still holding on to the highs of the last, I'd even say, 2 or 3 weeks or so. On cable, the first three-way split as far as voting was concerned on the MPC at the Bank of England here, going back to the GFC. So it's rare you see members looking for a hold, a hike, and a cut, looking at the same economy here. Bond markets, generally speaking, are on the way up, with yields pushing down as well. We're seeing the reversal, of course, in China, where we have seen a reversal of trend, and really that going against the grain. We have a bond auction today out of China, 30-year bonds. We should get details on that at some point this morning. The rest of the region, though, equity market-wise, Korea and Taiwan catching a decent bids, 1.3%. Singapore's half of 1%. Also might have to do with the fact that Korea inflation came through this morning. And, yeah, coming in at about 2.5% on core. We're watching, and this might be a story for the open, retail sales in Hong Kong for December actually recorded the biggest miss in about 13 months. We're looking at shares of Aozora Bank. That's a big mover in Tokyo very, very quickly. Biggest two-day drop since it became a public company. 34% on the 2 days. And, of course, we're also looking at Yvonne's point, Apple suppliers today. And here's a look at some of the big ones coming online over in Taiwan on the back of the Apple story.
Yep, so a bit of mixed picture there when it comes to what Hon Hai and Pegatron's doing, though. Quanta Computer's still up some 2.5% here. Let's get to the latest here. The Apple did return to growth in the last quarter, but the CFO, Luca Maestri, told Bloomberg that he's not happy with the decline in China, and telling our very own Emily Chang. For more on the big tech earnings, let's bring in Mark Gurman joining us from LA. I also want to bring in Sue Keen in New York. She's watching Meta, she's watching Amazon. Mark, I'll get to you first. The market seems concerned about that slump that we're seeing in sales in China from Apple. How concerned should we be?
I think we should be very concerned. 13%. That is the biggest holiday quarter decline for Apple in China since the holiday season in 2018, when you saw all sorts of issues with Apple in China. Obviously, China's Apple's third biggest market, but the importance to Apple outsizes that. That's where they produce many of their products. That's where some of their most important and highest spending customers are, right? So this is a really big deal. And you said at the top of the show that Apple returned to growth for this quarter, right? So they avoided 5 quarters in a row of sliding sales on an annual basis. Well, here's some more bad news for you, unfortunately, for Apple and its investors. That's going to happen again in the current quarter, in the March quarter. Apple said they were pretty confusing when they stated on the call, but you might be expecting a 6% annual decline for the current March quarter. And I would say at least some of that's probably going to come from China.
Right. Sue, I'll bring you in on the other earnings coming through. Let's start with Meta. That's where we're seeing quite a substantial move up in after-hours trade. There's a buyback there, but yeah, tell us what's caught your eye.
Well, one analyst called the results just spectacular. 25% increase in their sales, profit more than tripled, and they exceeded estimates with their outlook. Layer on the fact that they introduced a first-time ever dividend and added about $50 billion in additional share buybacks. That was enough to push the shares higher by better than 15%. The first quarterly dividend is a surprise. As you may recall, 2023 was what Zuckerberg called the year of efficiency, a lot of cutbacks, layoffs. It was a shaky 18 months, but now this combo of the share buyback, the dividend, the blowout numbers appear to be the signal the company's doing well enough and they want to incentivize investors. Zuckerberg said on the analyst call, it's been a good quarter, and quote, we've made a lot of progress on our vision for advancing AI and the metaverse. You're looking at the strong daily user numbers. Going forward, Meta is going to look at the revenue from daily users rather than just the numbers themselves. Meta, which owns Facebook, WhatsApp, Instagram, fared better than Alphabet's Google, which disappointed with its advertising results. They both get the bulk of their revenue from digital ads and heavily invest in AI. And get this, the CFO said the strong increase in fourth quarter revenue was due to heavy spending by China-based advertisers.
Yeah, there's a China theme in all of this, too. When it comes to Amazon, Sue, when it came to those holiday sales, there was a lot of competition with a lot of these Chinese e-commerce companies now, like Temu, for example. It seems like these earnings, though, from Amazon seems to at least shatter some of those doubts.
Yeah, absolutely. Strong holiday sales. In fact, the biggest online sales we've seen since the days of the pandemic. 9% increase there, 20% increase in third-party gains. It shows sellers are flocking to Amazon. And again, strong advertising, a sharp acceleration, according to Bloomberg industry analysts. Again, it shows that the CEO, Andy Jassy, is really doing strongly with the cost cutting. He's focusing on services that make money, and he's reshaping the once free spending company. Fourth quarter revenue up 14% to $170 billion, jumping about twice the level of expenses, which many analysts are really applauding there. It shows the efforts to cut costs are boosting profits without hurting the growth of the company.
Mark, can I bring you back in? Apart from the weakness in China, did the company highlight strength in other places, in other markets?
Yeah, you actually saw some really nice overall growth, right? 2%, despite the 13% decline in China. And in particular, you saw nice growth in the rest of Asia Pacific, places like Australia. You saw nice growth in Europe, as well as actually in the United States. So the iPhone 15 Pro clearly really did pretty well in Australia, parts of Europe like the UK and France, as well as the US. So there is a big silver lining there. The other thing is Tim Cook confirmed something that we've been reporting now for a few months. Their big generative AI announcement, that's happening this year. That's going to happen in June, from what I'm told, and the new features will roll out around September. So certainly something to look forward to. And obviously AI is the big buzzword for investors as well. And you could see the direct correlation between Cook's comment and the share price at that very moment. And then we heard about China and the outlook, and that sort of, sunk a little bit more. But overall, a mixed bag.
What about the Vision Pro? Obviously, there's quite a sticker shock when you look at the price tag of this. Are consumers likely going to really embrace these sort of handsets now, too?
Yeah, I think the Vision Pro at some point is going to become incredibly popular. I think it is the future of computing. I think in many respects it's going to replace the iPad one day down the road, right? The iPad sales there have been lagging significantly. I think you're going to see some people maybe buy one of these devices instead of that. How many people buy an iPad for travel and for watching video, right? The Vision Pro is at least 5 times better than the iPad at those functions, but also in many cases 5 times more expensive. Eventually the price will come down, the functionality will go up, and it'll be a hot seller. Maybe not in the holiday season of 2024, but if we're having this conversation in the holiday season of 2027 or 2028, it may all be about mixed reality headsets and the Vision.
Mark, thank you so much. Mark Gurman there, our tech reporter, and Sue Keenan, of course. Mark's in L.A., Sue's in New York for us. Right, to stay on tech here, so Jensen Huang, the CEO of Nvidia, says that the company is working with the U.S. amid tensions between Washington and Beijing over chip imports. We spoke exclusively earlier on, a couple of minutes back, and he told us more countries are actually seeing the importance of investing in sovereign AI.
India, Japan, France, Canada now, Southeast Asia, Singapore, speak up about the importance of investing in sovereign AI capabilities. It is become abundantly clear to each one of the countries that their natural resource, which is the data of their country, should be refined and produce intelligence of their country for their country.
All right, we'll have more from that conversation coming up. But still ahead, we got Stan Chart's Becky Liu joining us, seeing the pivot in global monetary policy, giving the PBOC maybe some room to ease further. We'll get their rates outlook in just a few minutes. Of course, we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Certainly, the theme this week has been this sapping of optimism here, just given what we've been seeing with these support measures. You know, we're still on track for a weekly drop when it comes to China equities. Futures, though, pointing slightly positive this morning. This is Bloomberg Markets China Open. Happy Friday.
Okay, futures are pointing slightly higher, though still brighter than our collective ones, me and Yvonne. Quarter 1% to the upside here. Excuse me. We're looking at a long list of sectors to track here, from property to suppliers to game makers. Some licenses coming through. That's true.
A lot going on.
Insurance firms. But that said, there's still the Fed conversation, data coming out of the U.S., and there's a big one tonight, of course.
Yeah, and you know, the U.S. jobs report is going to be interesting, right? Given that we have seen some strong data of late. Is this really going to test the sort of wait and see mode that the Fed seems to be really, heralding here after this FOMC meeting that we saw this week as well? Because we're hoping 185,000 is a consensus here, so a slowdown. But Bloomberg Economics says, look, there could be some noise in this data, right? Whether it's weather, re-benchmarking, seasonal factors, you got population revisions. So there might be some confusing signals here. The most important, they say, is the revisions. If we continue to see some slowdown, that might actually maybe force the Fed to maybe consider cutting a bit sooner than they have telegraphed as well. But certainly, yes, participation rate, or also expecting that employment rate to tick up higher to about 3.8%.
Okay, so is March still a hope, or is it now May? Are they definitely going to cut? Anita Nip is here with us, head of Asia Fixed Income Research at UBP. Let's start with that. They're definitely going to cut in the first half, right? Is that an assumption I can make?
Yeah, that's right. I mean, okay, the meeting yesterday basically are giving, a very strong signal to the market that rates have peaked and cut is coming on the way. But where, they will cut, when, it's, a puzzle. But our view is that May or June, they will start cutting. And in fact, our base case scenario would be they would cut 4 times this year, 25 basis points each. So altogether would be 100 basis points for this year. They will definitely look at, the data dependent, but we reckon May or June will be a timing for them to cut.
Okay, given just what they've telegraphed and what you're pricing, I mean, does that give the conditions better to extend duration at this point, or actually the opposite?
I would say, it's, the standard going forward for that one. Yeah.
Okay, so it doesn't change anything?
Doesn't change anything.
No.
Okay, talk to us about what you like. And let's start with, you have a new call in India.
That's right.
Yeah, tell us about that.
Okay, perhaps, we will come out from, the strategy basis, given the Fed is going to cut.
Okay.
Our preference would still be 3 to 5 years in terms of duration.
Okay, so no change on duration.
Exactly.
Okay.
On duration, no change, 3 to 5 years, quality IG credit. It's still our preference. But at the same time, because we anticipate, the cut is coming along, and perhaps clients can also look at some of the short-dated high yield. In Asia market, we reckon, the supply of high yield should be manageable this year, because most of the supply would probably coming from India, Indonesia. And, in fact, these company will be able to get their onshore domestic financing as well. So that means the supply in the US dollar market will be lower. We particularly like, for example, the Indian high yield. The main reason will be we reckon there could be some supply this year for the refinancing. Sector that we like include energy names, some telecom names, airport name. So Indian high yield at the moment, short dated, that is what we prefer, could yield at low 6%. We've seen it's still decent because we reckon even the cut is coming along, but at the same time we worry about corporate earnings going forward globally. So there could still be some sort of volatility in the credit spread. So going into the short data high yield would be something that could cushion a little bit on the volatility, and yet you would be able to get some carry.
Yeah, I wanted to you have a call on Japanese banks too,
yeah.
And obviously there's been a lot of focus on Aozora Bank, their exposure to U.S. commercial property. We've seen regional banks in the U.S. also once again these concerns about banking stress are resurfacing. Is this something that you think is idiosyncratic, a one-off, or do you think there's more to this story now?
Well, we like Japanese banks basically would be the bigger one. We reckon that even, the issues that you may, that you talk about, we think, it's manageable after we see that, all these years it has been stable in terms of real estate, sort of issues, etc. So we like the Japanese bank, the senior, or some of the AT1, but, there's not many AT1 for Japanese banks. So therefore, in order for investor to pick up, more on the yield, they can also refer to some of the Japanese insurance company. So in addition to the Japanese banks, because Japanese insurance company are also IG rated, and yet, the yield at the moment would be around like 6%, which is pretty decent if you're talking about IG. But perpetual would be something that would benefit from the rate cut as well. But we will look at the call date that is somewhere between 5 years, because again, our duration preference would be 3 to 5 years.
Right. Okay. Could you just explain that very briefly? Why does PERP benefit from the outlook on cuts?
Okay,
and not the other, and not the banks.
Yeah. Okay, usually for perpetual bonds, we look at both, their yield to maturity and yield to call. We also look at the reset as well. So usually we will reckon that in Asia, given reputational risk and if the rate is coming down, then the issuer would have more incentive to call back their perpetual. So that's the reason why we like some of those. Yeah.
Korea banks. Let's cross the sea.
Well, Korean banks are generally, a defensive strategy that we propose to client in general, because at the moment, a lot of them are trading slightly below 5% senior paper. Perhaps we can also look for opportunity for subordinated. But the things we like would be, it's a stable sort of, financial system, and also the rating at it, triple B or above. That would be something that really, it's attractive at this stage as an alternative to deposit.
We haven't talked about China yet. I mean, obviously, there's been a lot of news of this Evergrande liquidation. I mean, even Chinese high yield has actually done quite well.
Yeah.
Are you looking for opportunities there now?
At the moment, we're still pretty cautious overall on Chinese high yield. The main reason would be we still see some spillover impact or sentiment, sort of like cautious sentiment spill over from Chinese property to Chinese non-property high yield. So that's why at this stage, given, it's still uncertain about the liquidation process for China Evergrande, we reckon we would play a little bit, cautious and prefer the other areas rather than, Chinese high yield at this stage.
Yeah. Tell us what other areas, and I guess my other question related to that is how far up the risk curve do you go in terms of Chinese credit? Yeah.
I would prefer IG. For example, some of the SOE names, strategically important. I would rather play cautious rather than, too aggressive at this stage. The other we like would be China tech names, 5-year or below, in which it is IG with cash rich. But for China tech name, we have to be careful about those, geopolitical tension risk at this stage.
It's interesting you mentioned about short-dated notes. They've actually outperformed long-dated notes in some ways. Yeah. In fact, that divergence is quite wide. In particular, in Southeast Asia, you've seen it quite wide. Why do you think it is so wide?
You mean on the short-dated high yield or IG?
Doesn't matter. I mean, we're seeing that across these credit markets.
I guess overall for Asia market, people are still want the premium, the risk premium, even short-dated. That's why short-dated issues, people would still require some sort of term premium as well as risk premium. So that's the reason why they stay wide. Not until perhaps the dollar be weaker, then more flows into emerging market. So perhaps that risk premium would narrow down from there.
Have a good weekend.
Thank
Happy
you so
Friday.
much.
And it's
Happy
the
Friday.
head of fixed income research Asia at UBP. A couple of headlines coming through out of China as you look at this market set to open higher today. The fix of the day is 710.06, and the PBOC also draining 364 billion net renminbi in open market operations. All of that said, these markets are set to fly in Hong Kong. Tencent is up in the pre-market. HS Tech is called higher, 2.3%. Have a look at where we are. 8 minutes to the opening bell. This is Bloomberg Markets, China Open. Oh, yeah, there we go. So the news flows actually helped. So I guess on the back of just the broad macro stuff, gaming approvals coming through, and the news of which at least last, hour or so. And that's helping lift, as you can see, benchmarks. We'll talk more about gaming stocks in just a moment here. Broadly speaking, though, the weakness in the economy and just getting sapped out as far as bullishness and speculative spirits are concerned. Margin debt, right? We were talking about this lowest since September.
It just goes to show there's just not much appetite for people to really kind of, get into this market in some ways. In terms of analyst actions here today, there's a few pretty interesting ones. There is one on Chang'an Auto, that's from Morgan Stanley. That was upgrading to overweight, raising a price target on proving fundamentals and strong sales growth potential. ASMPT on top of that raised to a buy at Mizuho Securities. Medea Group also reinstated buy at William O'Neill. And we're watching, of course, tech, and all things tech.
Everything tech. Everything tech. So there's the chip story, well, as it pertains to AI, because there's a news out of the U.S., of course. I think the U.S. Defense...
yes, on AI.
On AI, yes.
Yes.
It came out late yesterday. Some of those companies, though, included in that list are private companies. There's the Apple part of the conversation today. Gaming stocks, we talked about that. In Wuxi AppTech, this is an A share, I believe, still?
Yes.
Or did they come up with H? Do they have H shares? Anyway,
Yes, they do. Yes.
1 billion, right?
Yes, 1 billion yuan.
Yeah.
1 billion yuan of buybacks.
We're just checking each other now. Shanghai comp 4-day slump, which actually might change today. And there's actually a bond sale, 30-year bond auction, local currency bond auction in China today. And just some context on Hong Kong retail sales, since we have a little bit of time. December numbers came out after the close yesterday, 7% pop. Expectation was 12-13%, the biggest miss relative to estimates in about 13 months or so. But anyway, back to the good news here.
Yeah, let's continue to watch these Apple suppliers, just given the concerns when it comes to the China sales. But look at that. I think, the Apple suppliers are not really concerned about the China story, but really the fact that they were able to avoid a fifth straight quarter of sales declines and actually bounce back. And so we actually saw some sales growth. That's really helping the likes of AAC Tech. Sunny Optical's up close to 3% right now. And we're watching very closely the gaming stocks. We talked about Tencent, NetEase. There you go. Tencent getting that pop of close to 5%. Meituan's also up 4.5%. Li Auto, watching BYD, Li Auto, some of these EV makers coming out with their vehicle deliveries for the month there. Li Auto did see quite a bit of a bounce from a year ago. Month on month, though, we are seeing some weakness in some of these EV makers, though. We have the Open coming up next. Looks to be a good Friday. This is Bloomberg.
Good morning and welcome back to shows. The final session of the week is upon us, a few seconds away, and as you can see, we're called higher in both markets, onshore and offshore, slightly higher here in Hong Kong on the back of perhaps the added oof we're getting out of these big tech names like Tencent and this new list of imported games that they approved from Feb 1 was really catching everyone. Positive surprise here.
Yeah, Tencent seeing a bit of a pop here. I think Nintendo was part of that mix as well.
Yeah, Switch games.
You add that to what we heard in that finance ministry officials there talking about, there's a little bit more necessary intensity to a fiscal stimulus to support growth. That certainly did lift some parts of this market as well. So we're ending at least on a positive note, but I think we're still set for some weekly losses here when it comes to China. Chinese stocks. There you go. Here's your pre-market in Hong Kong doing this. We're up 1% here. HS Tech is on fire, 2.3% to the upside. So it is sort of the Amazon, you said the Meta. It's also a little bit of the Apple effect here because those Apple suppliers are not too concerned, it seems, about that slowdown in sales in China. In fact, they're more focused on the overall growth of the company, it seems. There, Hang Seng continuing higher here. We're at 1.6%. MSCI China also seeing similar gains here. And we're watching very closely what happens to crude markets. We're down 2.4%, really kind of following what we're seeing with crude markets. On the Middle East, there's all this talk about maybe some sort of ceasefire deal. That's lowering the temperature here when it comes to geopolitical tensions as well. And CGBs, at least the Chinese 10-year, is seeing actually red, but it's flat. There you go. All green across sectors here this morning. In fact, we're watching Macau gaming stocks. That's up 2.5%. Also standing out is consumers discretionary, the like here. So certainly it is all boats are lifted here this morning. Thanks, of course, to that Amazon effect and really what we're seeing in big tech overall. And we're watching those Apple suppliers. So we saw basically, when it comes to Sunny Optical, AAC Tech, these are some of the big ones in Greater China that have exposure to Apple. And there you go. We're still seeing about 2% gains when it comes to Luxshare Precision. That's over on the A-share market. And we're watching BYD, XPeng, these EV makers coming out with sales figures here as well. As an interesting note from, I think, a Citi on BYD saying still decent numbers across the board here, and that certainly might help overall. The stock is up some 1% for BYD. XPeng, look at Li Auto. We're up 6.6% here right now. So the year-on-year number is certainly looking very good when it comes to some of these EV makers here today. And we're watching, let's just do a bottom of your screen, lower third on Wuxi. AppTech, there you go, or up 2%, that 1 billion yuan buyback that was announced this morning as well. We didn't even check Tencent and the like here, but yes, that should be part of that mix.
Yeah, look at the benchmark, you see Tencent with HS Tech doing that as well. Okay, do we have Wuxi? We don't have Wuxi, right? Okay, we'll talk about Wuxi later on.
No, it's there, it's there. Added it. It was in the bottom.
Okay, there we go. Okay, well, speaking of the bottom, that's where yields are in China relative to, I guess, recent years. For example, your 10-year yield is at 2.44%. How low do we get on that, given expectations of more easing coming through these next few weeks and months? Becky Liu is here with us on set, head of China macro strategy at Standard Chartered Bank. Good morning, and it's very nice to see you. So many analysts have been, I guess, in some ways reevaluating their predictions of how much monetary stimulus is on the way from the PBOC. Just give us what you expect to see in these next, say, 2 months.
We think for 2 months or throughout the entire 2024, the direction of China's monetary policy direction is very, very firm. It's basically just more easing. It's a matter of pace and it's a matter of when. After 2 very painful years for the PBOC, because they were the only major central bank that were cutting while the rest of the world was hiking, and hiking very aggressively. So each cut and each of those monetary policy easing over the last 2 years invites depreciation pressure on the CNY, strong capital outflows. And finally, they get into 2024 when the rest of the world is turning, and therefore it's a much better environment for them. And fundamentally, if we look at inflation, we think inflation is going to stay structurally very low. And at the same time, the authorities are showing very high level of conviction and very decisive to push forward for a continued economic transition. So that means there is only one direction where rates can go, which is lower for longer, in our view. So in the next 2 months, we do see a good chance for them to be cutting the MLF, and we do feel that they will need to cut that a bit further. So our base case is the PBOC will be cutting MLF rate by a total of 20 basis points of this year, and we don't rule out the possibility that they might be cutting more, up to 30 basis points. They cut 25 basis points last year, and they could do 20 to 30 basis points this year.
I think you changed your forecast for where these Chinese 10-year yields are going to go too, on the back of what you're forecasting now too. How low can these yields go?
Well, at the start of this year, we forecasted to go to 245, but it has just crossed our forecast. Yes. So from our perspective, the first quarter is probably the quarter where onshore fixed income market would have the strongest momentum. Aside from the macro considerations, there are two very important technical reasons. One is credit growth, especially loan growth, might be slightly lower in the first quarter. If we recall, the PBOC started to address the seasonality issue. After years of front-loading, it became too front-loading last year. So 46% of the new loans were extended in the first quarter, and they want to address that. So it means slightly slower credit growth in the first quarter, followed by stronger credit growth in the second and the third quarter. And second technical reason has to do with primary supply. If we also recall, the central government just issued an additional 1 trillion of bonds towards the late of 2023. And those money just got transferred to the local government. And over the past so many years, the combined official budget deficit at the local level had never exceeded 1 trillion. So 1 trillion of fiscal transfer all of a sudden from the central government is a lot. So they are cutting the first quarter bond issuance plans, and we will be also looking for a weaker than usual primary bond issuance in the first quarter as well.
So you think they've simply just taken forward what they would have done this quarter into last year? So I guess my question is net this year, where do you see CGB supply? Will there be a material change coming through?
We are looking for official budget deficit about 3% of GDP, and in addition...
That's small.
But in addition to that,
okay, there we go.
we are also looking at nearly 4 trillion of local government project bond issuance. And on top of that, we also feel that they will issue a special bond, probably not only this year, but in the coming 3 to 5 years, to support some mega projects. So infrastructure expenditure, including the so-called 3 projects, will likely to the primary growth driver this year.
So bring it back to when we saw that R cut, it was an unusual way of communicating, right, with Governor Pan announcing it live. It seems like there's a bit of a communications change here, being a little bit more transparent, more direct in talking to markets. There's also this reinstatement of this credit unit as well. What does that do in terms of helping to rebuild some confidence that really has been lost in this market?
We think that's an improvement. And at the same time, we also see the outsized R cut as part of a package to boost equity market sentiment. What we have seen over the last few quarters, they are partly shifting the liquidity injection through R cut into some other direct lending tools, such as PSL, relending, rediscounting. And those tools are more direct in terms of injecting liquidity to the real economy compared with the R cut. But R cut is the only tool that have such a high-profile headline impact that can boost market sentiment. So when Governor Pan was announcing the R cut, a package of other measures were also released at the same time to support the sentiment of the equity market. So we do feel there will be more R cut this year, but they will also use a combination of PSL and other direct lending tools to be better supporting the infrastructure funding needs.
How do they deliver, or they are delivering it now, how do they do this and also prevent the currency from collapsing? Because this is all this is all yuan negative.
Yes. So that's why we're only looking for the PBOC to be lowering MLF rate by 20 to 30 basis points. So I think consensus is looking for the Fed to be cutting more than 100 basis points. So at the end of the day, we will see smaller depreciation pressure for the CNY this year because of the narrowing interest rate differential. But after all, we have seen China rates went from somewhere that was 300 basis points higher than dollar rates to currently about 300 basis points lower than dollar rates. By the end of this year, it will remain a low-rate currency, although the gap is going to narrow. So we feel depreciation pressure is lightening, but it's not over. And the risk is for dollar CNY to move higher again after the Lunar New Year holidays, because seasonality will turn very quickly towards the negative side afterwards.
That's why you're saying PBOC, the fixings are going to be quite interesting moving forward. What sort of signals are you going to look for?
Yes. So since January, we started to see dollar CNY becoming very sticky again at around 710. So that implies the weak band at about 725. But we are not saying they are definitely defending the level of 725, but it's an interesting observation as what they were trying to do last year was keep the fixing almost at a straight line since mid-September, and therefore the upper bound was the de facto line of defense. So this year, given spot, it's still quite a bit far away from the weaker band. We don't feel that this kind of very strong and defensive intervention is going to return anytime soon. But what's relatively clear is that there is no incentive for them to weaken the CNY in order to boost export, because it's trade protectionism, tariff, that has been the key hurdle preventing China's exports gaining further market share.
All right, Becky, great stuff. Have a great weekend. Becky Liu, head of China macro strategy at Standard Chartered Bank, joining us. We're watching these chip stocks very closely. Obviously, we're all seeing plenty of green here when it comes to Adventus. We're up 3.5% here. We did hear from the Nvidia boss, the CEO Jensen Huang, saying the company is working with the U.S. amid tensions between Washington and Beijing over chip imports. Speaking exclusively with Bloomberg, he also told us more countries are seeing the importance of investing in sovereign AI.
You have seen India, Japan, France, Canada now, Southeast Asia, Singapore, speak up about the importance of investing in sovereign AI capabilities. It is become abundantly clear to each one of the countries that their natural resource, which is the data of their country, should be refined and produce intelligence of their country for their country. And that capability of refining the data of their country and turn it into their artificial intelligence is now possible in a quite a democratized way. Almost every country should be able to do it for themselves. And what's needed, of course, is the technology and the know-how of standing up AI infrastructure, and that's where we could be quite helpful to various regions. And so I think that the recognition of the importance of sovereign AI capabilities is now quite global.
Jensen, does that recognition and your ability to help extend to China?
Well, we're an American company, and we have to comply with American policies. And whatever the rules and regulations are and the laws are, we'll, number one, comply with that. Work closely with the regulators and understand their intentions and their desires, work within those boundaries, and be able to create products for the various countries that are involved, fully in compliant with the regulations that are in front of us. And beyond that, once we comply, our goal and the United States would love to see us be a successful country. And one of the pillars of national security is successful industries, and it creates jobs and allows our country to stay ahead and technologically. And so it is of great interest of our nation that our American companies are successful around the world. And so once we comply with the regulations, we'll do our best to serve the local markets. And we have we have excellent communications with the administration.
How should we think about sovereign AI as a business line for you? Is there a way that we can understand how Nvidia's work, even if it's building supercomputers like in the UK, for example, what proportion of your overall business that will represent?
The vast majority of the computing market has been United States and to a much smaller degree, China. For the very first time, every industry would be, every single country will become a computer industry, and every industry will become a technology industry. And so artificial intelligence, or the automation, the production at scale of intelligence, matters to every single country and matters to every single industry. And so for the very first time, there's a whole new computer market that is going to be in every single country and every single market. And it starts with, of course, the native computer industry itself. But you're seeing a great adoption in healthcare, great adoption in logistics, in transportation, of course, in manufacturing, in the large industries, the heavy industries. For the very first time, because of generative AI, computer technology is going to impact literally every single industry in every single country.
All right, that was the Nvidia boss, Jensen Huang, speaking with Ed Ludlow a little bit earlier on. And we're watching one sector in particular as well. Gaming stocks are on a tear. Take a look at Nexon, limit up in Tokyo here this morning. We're up some 22%. That along with Tencent after this surprise approval for long-awaited games. If you're a fan of mobile DNF game, that got the green light as well. There you go. So we are seeing Bilibili also up some 6%. That's really helping the lift left. The HS Tech Index up more than 2.5%. This is Bloomberg.
Okay, welcome back. So 16 minutes into the session, developers on your left, granular. The index is on the right, longer term look. That's a 20-year look. So suffice to say it's good today. It hasn't been good recently. The latest here is certainly H came in with the Fed this week, still warning the public that they should be assessing the risks as it pertains to, do you make that purchase now because they think rates will remain higher for longer and not necessarily fall as quick as perhaps what markets think where the Fed goes actually.
Yeah, that's a pretty strong message, right? And, you know, two words. Negative equity. You take a look at what we've been seeing. The value of mortgages in Hong Kong exceeding the worth of homes have surged now to a 2-decade high and what's forecast to be one of the world's worst property markets this year. Joining us now is Bloomberg Intelligence senior APAC real estate analyst Patrick Wong. Patrick, why is the situation getting worse?
Yeah, it looks like really scary. We have more than 25,000 cases, right, like the equity. And the challenge, I think, is now we have the property price down over 20%, right, over the past 2.5 years. And it makes the situation really complicated when we see the government also easing the mortgage quite a bit, rising the loan-to-value ratio, and then now the buyers can borrow more, right? It makes the equity easier, actually. So it's a very complicated situation overall.
Yeah, because you leverage further up, right? The smaller the equity go. How does this ratio, this rising value of negative equity, how does that affect the developers right now?
I think for the developer side, it's also challenging because they find very difficult to sell the new apartments. The inventory level is also getting higher and higher, and it's more than a decade high at this point. And the thing is that for the potential buyers, they also think about the potential risk, right? When the negative equity is so high, right? So they will think twice before they buy any apartments. And even the mortgage easing or the stamp duty cut over the past couple of months, and it makes the property market still not really rebound quite a bit, right, in terms of the transaction volume. Even the price is still falling. I think you need to wait a little bit until the mortgage rate really coming down at this point.
So do you expect other measures then, if the ones that you've just highlighted so far hasn't really done enough to turn around this market?
I think the government is also assessing the situation and upcoming the budget speech, and then we will see if the government do anything. But I think the revenue from the government perspective, because the developers, they didn't got any chance to buy new land at this point because the developer sales coming down quite a bit. So it makes the developers, they will think about whether they can buy more at this point. But yeah, I think the government need to think about if they can cut rates further on the stamp duties to attract more demand to support the market.
All right, Patrick, thank you. Patrick Wong there with that gloomy outlook. Bloomberg Intelligence, APAC real estate senior analyst, though. Let's talk a little bit more about Hong Kong here. Its plans for a new security legislation is creating fresh anxiety in the financial hub and could undermine the city's efforts to revitalize the business environment. For more, let's bring in our Asia government and economy correspondent, Rebecca Chung-Wilkins. Article 23 coming back as a focus here. Just bring us up to speed on why we're seeing this new legislation.
Right. So Article 23 is actually mandated and required under the Mini Constitution from way back when in 1997. But there's always been a lot of fierce opposition to that. But Beijing's national security law that was imposed in the wake of the protests back in 2019 has essentially cleared the way for this to come through. It has effectively quashed all of that opposition, all of that resistance, and has allowed the government to, what we assume, kind of quite quite smoothly pass this set of national security laws now. I think the issue is, as much as this was long anticipated, is that sort of people in the community who've spoken to us say that it's more expansive than they thought. There was this notion that we were going to see a sort of smaller, more concrete version of that existing Beijing NSL framework. And instead, we've seen something that's quite broad, with these very expanded definitions, for example, of state secrets, which mirrors the language that we see in Beijing on there, how they define state secrets. And those are the kinds of things that people feel a bit uncertain about.
And speaking of, we've seen businesses react to this latest survey, of course, out of AmCham, for example. Tell us more about the response to these seemingly new additions, if you will, to put it that way.
I think there is this real fatigue over sort of this insistence and what appears to be this relentless slog by the government to be tackling these national security issues. Think about the Hong Kong bounties put on activists. And so this AmCham report is interesting. There's 2/3 of respondents saying, mainly US firms, saying that they just want the Hong Kong government and the US government to just stop talking about national security. That is the main and the biggest reason that they think will help actually improve relations, even as they see that US-China relations are going to be the biggest concern that they have over the next 12 months. And it is that continual focus, I think, that is also unsettling. It sort of disrupts this projection that the government wants to give, that it's business as usual here.
Rebecca, thank you. Rebecca Chin-Wilkins there. You can read about her story on the terminal, also on the website. There are Asia government and economy correspondent. Right, plenty more ahead. These markets are bid. Cash markets, as you can see on your screens. That's property. You'll see the benchmarks next. This is Bloomberg. Okay, we're looking at Anta Sports, the IPO, of course, overnight. Related company there, 6%, of course, as it's clocked in its first day as a public company, raising that much amount of money. 5% up in Anta Sports. Lots of other things. Now, speaking about gaming, but certainly a different type of gaming. This is more indoor than the outdoor space here. There you go. So the gaming stocks, not just in China. So Nexon is a Japanese listed company, are all catching a very strong bid. And this announcement did come as a bit of a positive surprise.
Some of these long-awaited games that we're looking for that green light finally got it here. So more signs of maybe regulatory risk being faded here. Nexon up, limit up this morning. HS Tech is up some 2%. It's a good day if you're long these markets. We got plenty more coming out when it comes to what's going on here. This is Bloomberg.